All right, what's going on, everyone? Today I'm going to talk about SMT divergence. It's been showing up a lot lately on some of the best reversals, and it's always been a major component to how I spot reversals on the ES and the NQ futures. And it's a really simple price action pattern. So it's going to be a very quick video, and we can just knock this out, and you will be very, very proficient in spotting SMT after this video. So we're going to go over some basic examples right here on a blank chart, and then I'm going to go into some real life examples and annotate the chart as I explain it to you guys. So what we are looking for is a divergence in the price action between the ES and the NASDAQ. Now, it's important to understand that you can use this with any correlated asset. So for example, if you trade Forex, you could use this on the Euro USD and the GBP USD. You could also use this on the YM and the ES or the YM and the NASDAQ, but I have had the most success leaving YM out of the picture, and I only look at SMT divergence between NQ and the ES. So let's just say this is ES right here. ES makes a higher high, higher low, higher high, higher low, higher high, and then we fall down, right? And we make a lower low. Now, NQ makes a higher high, higher low, higher high, higher low, lower high, lower low. So the divergence in the price action would be right here. So where ES makes this higher high and then it falls down, NQ makes a lower high at the same time. That is the divergence in price. So it's a very similar concept to something like RSI divergence, but with this, we're focusing on price action. And from my experience, price action divergence is so much more immediate and powerful than an RSI divergence, which can, I'm sure if you've looked at it before, it can kind of build and build and build, and you don't really know when that reversal is actually going to happen. The cool thing about price action divergence like SMT, it's a lot more immediate. So this would be the bearish scenario. Now we can go over the bullish scenario real quick, right? So let's do that. So let's say this is ES. ES is down at the lows, makes a higher low, higher high, higher low, higher high, right? So let's say this is ES price action, and let's say we tapped into some type of higher time frame PD array, like a bullish fair value gap, whatever it may be. NQ also taps into a bullish PD array of some kind, but instead of making this very simple higher high, higher low, higher high, NQ does something like this. Taps into that level, makes a high, sweeps that high, then makes the higher highs and higher lows. So the SMT in this case would be right here. ES made the higher high right here, and Q actually swept out that low. So it swept the liquidity. Now, it's important to understand, because a lot of people ask me this. They say, do you have to pick? Is there like a certain asset you should pick in this type of scenario? No, it doesn't really matter. You can trade either the ES or the NASDAQ. They're both going to present this reversal signal when you have a valid SMT, but technically, in the case of a bullish SMT like this, technically they would say that the ES is more bullish because it is the one that made the higher high, or the higher low, excuse me. So there is relative strength over the ES than the NASDAQ technically, but from my experience, I just take whatever has the better setup. So whichever one presents more clean, that's the one I'm going to take. And 90% of my trades are on the NASDAQ. So I don't trade ES like that, but I use ES and I look at it constantly, specifically just to spot the relative strength and weakness between the two indexes and try to spot SMT divergence for my trading strategies. Now, we're going to get into some real live examples, and all the examples I'm going to show you, we're going to go over two. They both happened this week. So I want to make this clear. This is not a signal that happens once in a blue moon. You get these divergences all the time, and it's important to understand we're going to go over a higher time frame example and a lower time frame example. And just like anything else in price action is fractal, right? What happens on the 1 minute happens on the daily chart. But the only difference is that if something happens on a daily chart, it's going to be a more reliable signal, but also it's going to have a bigger move. That's it, right? A daily time frame SMT is going to operate on a daily time frame horizon, whereas a 1 minute SMT divergence is going to operate on a 1 minute time horizon. So we're going to go over both examples though. So let's get into some real life examples. And one more thing, obviously, this is not a trading strategy by itself, right? It helps you spot reversals, but you still need an entry signal. You need an entry system. And for me, we're going to go over like my model using SMT. There's two ways I use it. We're going to incorporate fair value gaps. So number one, you want to tap into, in the case of a bullish SMT divergence setup, you want to tap into some type of bullish higher time frame level. All right. So in example, if we're looking at like a 5-minute chart, we want to tap into some type of like 4-hour or 1-hour bullish fair value gap, order block, whatever it is, a classic support level, however you trade, doesn't really matter. You want to tap into a relevant key level. And you also want to have context that you're looking for longs anyway, right? You don't want to just trade SMT just because it's there. You want to already have a narrative and be looking for some type of setup, and then seeing the SMT divergence is just a really strong confluence that you're going to be on the right side of the market. So what I look for, tap into a higher time frame bullish level, and then I want to see either a pullback into a fair value gap, so something like this, and then I would look to take the long inside the bullish fair value gap that was created, or we're looking for an inversion fair value gap. So we'll go over both ways to use this, but that would be inverting or running through a bearish fair value gap. Same idea. Really doesn't make a difference. Those are my entry signals, and they work really well with SMT divergence, trading ICT. But you can use any type of entry signal. If you use VWAP breaks, but you are also looking at the SMT divergence to help spot the reversal, that's great. Doesn't really make a difference. So let's get into some some real life examples. We'll start on the medium time frame. So I have a pretty cool 15-minute signal that we can go over that one first. So let's get that going. 1 second. All right, so for this first example, we're going to be looking at the 5-minute chart first. All right, so we have NASDAQ on the left right here, and we have the ES on the right. Now, if you see right here, this candle at 3:35 a.m. on Wednesday, so that was this week. You see right here, NQ from this candle to these candles at 7:50 a.m. on Wednesday, same day. NQ makes a lower high, right? If we go to ES and look at the same candle, so again, 3:30 a.m., we put in this high. ES takes out this high, right? So it sweeps the liquidity and makes a higher high. This is our divergence in price action. So NQ makes a lower high. ES makes a higher high. There is our bearish SMT divergence. Now, I'm going to go over my entry model, but I want to go over a few things first. So now that we have the SMT and we show it's here, I'm just going to go and focus on the NASDAQ now, because this is the most important thing to be able to recognize that we have the SMT divergence. So let's go back to the NASDAQ and focus on this here. I want to kind of dissect this price action. To do that, we're actually going to go to the 4-hour time frame before I get into the entry model in here. So let's go to the 4-hour. Now, we had a major sell-off on Wednesday, right? Really massive sell-off, and we traded into the new week opening gap, which is right here. So this is that inefficiency, open gap. This was our draw on liquidity on Wednesday. And I did want to see the market trade into here. Now, I did not think that we would trade all the way to this gap in a single day in the New York session, but that is what we did. It was a really powerful move. But one of the key components that had me getting ready to finally look for that new week opening gap move was a 4-hour bearish SMT divergence. So we're going to go over a 5-minute example on the lower time frames that really kicked off the move on a lower time frame horizon, but using the higher time frame, like I said before, it doesn't matter what time frame we're looking at. It's the same signal. Price action is fractal, but the only difference is that on a higher time frame, we are going to have a higher time frame type of move. So from this candle at 1400 hours on the NASDAQ, if you see right here, NQ sweeps it out. So we take this high, right? Let's go to the ES real quick. On the ES, I want you to pay attention to that same candle right here, 1400 on Friday. ES does not take out this high. It puts in a lower high. So this is our 4-hour bearish SMT divergence. And this is what kicked off this sell-off to the new week opening gap on both the ES and the NASDAQ. So Again, we're going to go over the example on a 5-minute time frame on how we got our entry for the trade and how you can find your entry using my model. But it's important to have this context. Using it on the higher time frames as well is just going to increase the probabilities of your move and the way it'll play out, right? So again, SMT divergence on the 4-hour time frame, ES makes a lower high, while the NASDAQ, as you see, made a higher high. So that is our price action divergence on the indices on the higher time frames. Now, let's go back to the 5-minute and go over the setup. So once again, we already went over this. We also had the SMT on the 5-minute time frame. So ES made a higher high, NQ made a lower high right here. Now, like I was saying before, that doesn't mean we just automatically get short, right? We need to have an entry signal. We need to have our entry model. And I'm going to go over mine with you guys. I'm going to explain exactly how I do this. So right here is 7:50 a.m. Now, I'm not trading before 9:30 open. I wait till the open to look for my trade entries. So I want to get to 9:30, and that is right here. So by 9:30, what have we done? We had put in that SMT divergence on the 5-minute time frame. And what did I say I want to see to give me a valid entry model? I want to see a break of structure, some displacement to the downside in this case, and I want to see either a pullback to a fair value gap or I want to see an inversion fair value gap. Now, we have examples for the inversion entry model, and we have an example in the more traditional pullback into a fair value gap. So I have the bearish fair value gaps marked out right here. Now, what do we get after the SMT divergence? We get our lower time frame break of structure right here, or change in the state of delivery. And what do? We pull back to the bearish fair value gap on the 5-minute. And now it's really important to watch how the candles are printing once we retrace into this gap. What we don't want to see is a 5-minute candle closure back above this fair value gap, because that would invalidate the move. But we get a lot of consolidation inside this gap, but we cannot close above it, showing that the market is respecting this bearish level. And what do? Once we can't get a closure above it and we get our market structure shift, we fall down lower. Now, the entry that I took, though, was not here because this is still before the 9:30 open. I was watching this move play out, but I don't take trades before the 9:30 open. We had another confirmation. So we had an even clearer break of structure right here. So the market takes out this low. So we get another break of structure. And what do? We create a 5-minute bearish fair value gap right here. We pull into that fair value gap, and this is your entry, okay? So you can either have a limit order set here. I get in with limit orders at my key levels. It helps me get better entries. Some people like to wait, and they might look for an entry on a confirmation candle like here or somewhere down here. That's perfectly fine. I like to get in at limit orders at the prices that I want. So limit order inside the 5-minute bearish fair value gap. And this is where it's important to have a draw on liquidity. That's the other component to having all of the confluences aligned for your higher probability setup. So what was the draw on liquidity for me? Very simply, we have these stacked lows right here. So we have these equal lows on the 5-minute time frame, perfect equal lows. That was the draw on liquidity for me. So just to wrap up everything that we have here, 5-minute SMT divergence right before the open. Remember the context of the higher time frame as well, 4-hour bearish SMT divergence. So we have even more context that we might be getting ready for a higher time frame reversal. Then we start zooming into the lower time frames and we find our confirmations. 5-minute SMT divergence. We have equal lows right here as a very clear draw on liquidity. So we have a directional target as well. And then what do we get? We get the price action to play out the way we want it to, right? We get the SMT. We get a change in the state of delivery, pull back into a bearish fair value gap. We respect it. Then we get our break of structure. And what do again? Pull back into the bearish fair value gap. And we have our limit orders set inside that gap. And we're targeting the equal lows. Now, just looking for that and just using your stop at a proper structure point, you can get 2R in like 5 minutes just on that alone. But again, if you're using higher time frame context and you think that we might be drawing towards that new week opening gap, that's where there's so many different ways to trade, right? It depends on what type of risk reward you're comfortable with, how long you're comfortable with holding trades. I'm more of a scalper. I like to get in and out for like 1.5 to 2R, and I like to just kind of stack those base hits. But there was a lot of confluence to hold this for like a home run type of move. Now, again, I don't need to do that. I'm happy to catch my 2R, target the low hanging fruit right here, and get a high probability setup. But this is the first example. I mean, just a really clear example of the SMT divergence confirming the reversal for you, and then using price action to really get the proper entry and then having that clear draw on liquidity. So that's example one. Now we're going to get into the second example, and it's going to be the bullish case so that you can at least see both sides of the move. All right, so let's get into our last example here now. So again, we're going to be painting this SMT divergence, but this time it is going to be in the bullish scenario. So I want your eyes to come here to the NASDAQ here on the left. As you can see at this candle, so 9:45 a.m. on Tuesday. So again, this is all this week. All the examples are from this week alone. What do? We put in a higher high, we start to consolidate, and we end up putting in a higher low right here on NASDAQ, right? So if your eyes go to these candles around 2 p.m. Now, if we go to the ES, what's different about the ES? Our candle right here around 10 a.m., 9:45, the ES actually takes out this low. So the ES makes a lower low right here. So that is our divergence in price action. There's our SMT divergence. NQ makes a higher high, or a higher low, excuse me. ES makes a lower low. So now we have our bullish SMT divergence. Now, also looking at ES, do we tap into a bullish PD array or a bullish level? We have this 5-minute fair value gap right here that the market cannot close below. And then we move higher. Now, again, I took my trades on the NASDAQ, so we're going to focus on that. And this time we're going to go over the inversion fair value gap model. Now, again, it's essentially the same thing, but instead of waiting for a bullish fair value gap to form and then looking for a retracement into that level, we're going to use the inversion fair value gap model, where in a bullish case, we're looking for a bearish fair value gap to get disrespected or ran through, and that's our confirmation to go long. So now this setup did take a while to present, right? This is 9:30 open. We put in our higher high, higher low, we consolidate. We put in our higher low ultimately, create the bullish SMT divergence, but we don't really get an entry, at least not for the inversion fair value gap model, until late in the day around power hour. But this is the thing. If this is when the setup presents, then this is when you're going to take it. Now, this is the inversion that we used. All right. Now, you could have probably, if you're on the 1 minute or on the lower time frames, found an entry somewhere in here inside of this chop. You know, it's not that bad. We do put in a higher high, higher low, and then we move higher. The inversion fair value gap in this scenario did take a bit longer to set up, but that's fine. We got the best confirmation for this move. Now, again, the inversion fair value gap is simply looking for a bullish close over a bearish gap. So we get long inside here, right above the gap. Now, in this case, where your stop loss is going to go is a bit discretionary. For me, I don't like to have ultra wide stops. It's just not how I trade. I'd rather have a tighter stop. And this is the thing. When you're using the inversion fair value gap model, ideally, now nothing ever works out perfectly, but on the best inversion fair value gap setups, which are the ones you want to be taking, you're not going to go back below that fair value gap. That's when it's going to work out best. So for me, my stop is just below these wicks because I have a ton of room below the inversion fair value gap for there to be some consolidation or some chop, right? Some people might want to put their stop, here or here, and that's fine. Again, I like to use tighter stops, and especially with the inversion fair value gap, we really don't want to see the market go back below that level once we run through the gap. It's essentially like a break and retest of that level. So that's what we got, and luckily we did not consolidate after that. This was the confirmation for us to move higher, and you can capture a very clean 2R and virtually no chop or consolidation in here. And we can use this high as our draw on liquidity, right? So we're looking to take out this high. We do that, and you can get a clean 2R, which is about 65 points. with a 32-point stop loss. But again, what are the main components of the setup that is feeding the long bias? The bullish SMT divergence, all right? The divergence in price action. And then once we have that, we look for our entry model. So in this case, it was the inversion fair value gap, and we target the high of day, or we target like a standard 2R, or if you're someone that goes for 1.5R or 1R, you're able to get that move. So that's the second example. But again, the most important factor is the SMT divergence. Start training your eyes to not just, if you just look at ES, take a look at the NASDAQ. Watch how these markets are trading in correlation with each other. Map out the relative strength and weakness between the two, and you will get better at spotting SMT divergence on your own, right? Like some people use indicators to help them spot this. I understand that in the beginning, but if you just look at the ES and the NASDAQ together, flip through the charts when you're looking for setups, you'll be able to spot SMT divergence like the back of your hand. It's a really easy, simple price action pattern. So I challenge you to start looking at this, start back testing it, go back into the charts, look at higher time frame examples, look at lower time frame examples, even down to the 1 minute, even down to the 15-second if you want. Price action is fractal, but I promise you, all of the most significant reversals are going to have this price action divergence on them. Like I can almost promise you that I would say probably 75% of significant reversals are going to have this divergence between the ES and the NASDAQ. So that's your homework. If you want to prove me wrong, prove me wrong. Show me 5 examples that you could find of significant reversals in the last month that did not have this divergence in price. That's your homework. But I hope you guys, learned something here. I hope I was clear and concise with how you could actually spot this. If you have any questions, my DMs are always open. Until the next video, have a good one, guys. Take care. Peace and love.